Convertible notes. What are they? You may have seen these when looking at a startup that's trying to raise capital. Put simply, a convertible note is a type of debt that converts into equity, or shares in the company. You as an investor would essentially be loaning money to the startup, but instead of a return in the usual form of principal plus interest, you would receive equity in the company at a later date. Startups use convertible notes for two primary reasons. LLCs use them to put off the costs to become a corporation until a later date, because LLCs cannot issue stock like a corporation can. Convertible notes can also be used to put off valuing the company at such an early stage, where there usually isn't much to base the value on. Instead, the valuation will usually be postponed until the startup begins raising Series A financing in the future where the valuation can be more exact. When looking at a convertible note, there are a few big things to keep in mind. The first is the discount rate. This represents the valuation discount you receive relative to investors who invest during later funding rounds. This compensates you for the additional risk you bear by investing in them earlier. For example, if the convertible note offered a discount price of 20%, and an investor in the Series A round offers to pay $10 for each Series A share they buy, then the 20% discount means that you would only pay $8 per share, instead of the $10 per share the Series A investor paid. If you bought $1,000 in convertible notes, you would receive 125 shares at $8 per share, instead of the 100 shares the Series A investor could buy with their $1,000. But that's not all. Convertible notes also gain interest. The interest rate defined by the deal terms has been accruing since you bought the notes. This interest is used to buy even more shares when the note converts, increasing the number of shares you own even further. Another term that matters is the valuation cap. The valuation cap is an additional reward for bearing risk early on. It effectively caps the price at which your notes will convert into equity. Some notes only offer a discount price or a valuation cap, but many offer both. In the case where both are offered, the notes will convert using either the valuation cap or the discount factor, but not both. Which one is used depends on which factor gives the investor the better price per share. Here's an example of how valuation caps are used. The startup in this example offered a convertible note with a valuation cap of $4 million and a discount factor of 20%. When raising for its Series A round, the startup gets a pre-money valuation of $6 million, which just means the company is valued at $6 million before they receive any money from Series A investors. The price per share in this example is $10. To find your price per share, we divide the valuation cap of $4 million by the pre-money valuation of $6 million for a factor of 0.667. Then you just multiply that times the price per share. In this case, you get a price per share of $6.67. In this same example, the discount rate of 20% gives you a price of $8 per share. Since this is higher than the $6.67 per share the valuation cap determined, the lower of the two, being the valuation cap, will be used to determine how much you pay when your notes convert into equity. Two more important things to look at with the convertible notes are the maturity date and the conversion trigger. The maturity date is when the note becomes due. If the note hasn't converted by this date, the company becomes responsible to pay it back, or pursue other options as defined by the deal terms. The conversion trigger is the predefined set of conditions that will trigger a conversion from debt into equity. Pay special attention to this part of the deal terms because it lets you know what conditions need to be met before the debt will be converted into equity. This is just a broad overview of convertible notes, and there are many variations that can change the structure, so be sure to read the fine print. But in the end, convertible notes are just another vehicle to get the investor and the entrepreneur closer to their end goal of creating wealth together.